China holds $870 billion of American debt, and right now, in 2026, Chinese regulators are reportedly telling their banks to stop buying U.S. treasuries. Some are even being told to sell. This is not a rumor. This is happening right now. So today, we answer the question that could define the next decade of American history. What actually happens to America if China stops buying its debt? Higher mortgage rates? A weaker dollar? Stock market crash? Or is it all just noise? I'm going to walk you through every scenario, from the manageable to the catastrophic, because understanding this is essential to protecting your money right now. Before we get into what happens, you need to understand why China owns American debt in the first place. For decades, China ran massive trade surpluses with America. Every time an American bought a Chinese product, dollars flowed to China. China had to do something with all those dollars, and U.S. Treasury bonds were the safest, most liquid investment in the world. So China bought them. At the peak in 2013, China held $1.3 trillion in U.S. treasuries, the single largest foreign holder on Earth. But since 2013, China has been slowly and quietly selling, from $1.3 trillion down to $870 billion today, a reduction of over $400 billion over 13 years. Not a dump, a slow, strategic exit. And the question is, are they about to accelerate? So why now? Why is China accelerating its exit from U.S. debt in 2026 specifically? Three major reasons. Reason one, the trade war. Trump raised tariffs on Chinese goods to 145%. China retaliated, and financial weapons are now on the table. Chinese officials literally stated, with tariff rates at the current level, there is no longer a market for U.S. goods in China. This is economic warfare. Reason two, Xi Jinping's grand plan. China's Communist Party journal literally published President Xi's speech calling for the yuan to replace the dollar as the global reserve currency. This is official Chinese policy, not speculation. Reason three, the Russia lesson. When America froze Russia's reserves after Ukraine, China watched and realized our $870 billion in U.S. treasuries could be frozen too. They want out before that risk becomes real. Now let's go through the actual scenarios. What happens if China sells? There are three levels: slow, medium, and nuclear. Scenario one. The slow sell-off. This is what's actually happening right now. China gradually reduces holdings over months and years. The U.S. Treasury market is massive, $39 trillion. China's $870 billion is only about 2% of total U.S. debt. If they sell slowly, the Fed can absorb it through quantitative easing. Interest rates go up slightly. Maybe your mortgage rate increases by 0.25%. The dollar weakens modestly. U.S. manufacturers actually benefit from a weaker dollar because their exports get cheaper. This is manageable, uncomfortable, but not catastrophic. And this is the most likely scenario. Scenario two, the medium sell-off. China decides to accelerate, sells $200 to $400 billion over 12 to 18 months. Now things get serious. Treasury bond prices fall significantly as supply floods the market. Yields spike, meaning U.S. borrowing costs surge. The 10-year Treasury yield could jump to 6 or 7%. What does that mean for you? Your 30-year mortgage rate hits 8 or 9%. Home buying becomes unaffordable for millions of Americans. The housing market freezes. Car loans get more expensive. Credit card rates go higher. The stock market sells off as higher yields make bonds more attractive than stocks. The dollar weakens significantly, making everything imported more expensive. Inflation surges again. The economy slows sharply. This is a recession scenario. Painful but survivable. America has been through worse. Scenario 3. The nuclear option. China dumps everything, all $870 billion, immediately. This is what economists call a financial nuclear bomb. Treasury bond prices collapse overnight. Yields explode to levels never seen in modern history. The stock market would crash within days, potentially 30 to 50%. Money market funds could break. Banks would face severe stress. The dollar would plummet. Inflation would surge violently. But here's the thing most people miss. This would also destroy China. If China dumps $870 billion in treasuries, the price of those bonds collapses, which means the value of China's own remaining portfolio collapses. China would shoot itself in the foot. A destabilized America means Americans stop buying Chinese goods. China's export economy collapses. Their banking system, which is already stressed from the property crisis, could implode. This is mutually assured financial destruction. And that's why most serious economists say China will never pull the nuclear trigger. The threat is real. The execution is suicide. But here's the bigger picture that goes beyond just selling bonds. China's real goal isn't to destroy America with a debt dump. Their real goal is to slowly replace the dollar as the world's reserve currency with the yuan. This is Xi Jinping's stated plan. And in 2026, it's gaining real momentum. The dollar's share of global reserves has fallen from 72% in 2000 to about 57% today. The yuan has grown from nearly zero to about 2% of global reserves. Countries like Russia, India, Brazil are increasingly trading in yuan, not dollars. Central banks worldwide are buying gold as an alternative. That's why gold hit $3,300. But here's the reality check. The yuan faces one massive obstacle China can't solve. Their capital account is closed. Foreign investors can't freely move money in and out of China. No serious investor will hold yuan as a reserve currency if they can't access it. The dollar's dominance is challenged, but nowhere near threatened. Not yet. So what does all of this mean for your money right now? 4 things you need to understand. Number 1, interest rates are going to stay higher for longer. Whether China sells slowly or not, the U.S. needs to borrow more every year. More supply means higher rates. Your mortgage, car loan, and credit card rates will remain elevated. Plan accordingly. Number 2, the dollar will weaken over time. Not collapse, but weaken. This means the things you import get more expensive. It also means international investments could outperform U.S.-only investments. Diversify globally. Number 3, gold and real assets will continue to rise. Every central bank on Earth is buying gold as a hedge against dollar weakness. You should consider doing the same. Number 4, this geopolitical tension creates stock market volatility. Every time U.S.-China tensions spike, markets react. Having cash reserves allows you to buy dips rather than panic sell. Here's the bottom line. China stopping U.S. debt purchases is not a binary event. It's a slow-moving tectonic shift that has been happening for 13 years. The nuclear option is a theory, not a plan, because China knows it would destroy itself too. But the slow exit is real, it is happening, and it will affect your life through higher interest rates, a gradually weaker dollar, and more financial market volatility. The smart move is not to panic, but to understand what's coming and position yourself accordingly.
Subscribe, because next week we're breaking down exactly what smart money is buying right now to protect against dollar weakness: gold, international.
Subscribe to Mila Invests. Thank you.